Hey guys, welcome to Aetherium Capital. Today I'll be discussing about some high quality convictions that I have and high quality stocks that I want to buy. However, they are currently trading at high valuations and what are my plans for them. So first of all, we can look at some high quality names. Over here we can see there's Microsoft, there's Visa and MasterCard, there's Hermes and there's Ferrari. So if you ask me out of these four over here, which one is the one that I think is the weakest? And for me personally, I believe that Visa and MasterCard is the weakest out of these four here. Microsoft will be the strongest, the second strongest is Ferrari, the third is Hermes, and the last will be Visa and MasterCard. So the reason why Visa and MasterCard currently the moat may be threatened is due to the fact that there is a recent rise in interest in stablecoins, and as the US government adopts more pro-crypto scams, what happens is that Visa and MasterCard's transactions volume may actually drop as people become more accustomed to using crypto as payment functions, as well as business may also use crypto as well. So first of all, let's look at the reason why high stock valuations may not necessarily matter if they are actually proven compounders.
Sorry, we got it. The microphone's over here. Yeah, just raise your hand and the monitor will supply the microphone.
Thank you. Howard Winston from Cincinnati, Ohio. One question. Are you concerned about the rising valuations on the NASDAQ market where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they trade at 10 times revenues or more, 30 times revenues instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced and phony stock promotions and the gullible being led into to believe in things that just can't come true. So that's always gone on. It always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. It really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years, but it's very tough to make money being short them. Although we tried a few times way back, we don't look at indicia from stocks in general or from PEs or price sales ratios or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola, the 8% we own of Coca-Cola, 11% of Gillette, if they said we're just going to delist the stock and we're never going to, we'll open it again in 20 years. It's fine with us, and then if it goes down on the news, we'll buy more of it. So we care about what the business does. Yeah. Norton, why don't you give him the microphone there?
Thank you, Warren, for including me. out of order.
It's good to have you here. Norton represents a family that came in 1956. Yeah, that joined up with the partnership and been with us ever since.
Very, very fortunate connection.
Both ways, Norton, both ways.
And,
Careful, Norton. We don't want you mobbed on the way out.
But I might say that it all began with my father discovering, thanks to a professor of finance that was also at the University of Oklahoma, Ben Graham back in 1940. And then later, when Ben Graham was about to retire, we were trying to find his protege. And clearly that was Warren, and so he belongs to that long tradition. But the question I wanted to ask was, you've mentioned the very strong companies that Berkshire has that are really international companies like Coca-Cola and the Gillette. But are you considering, or have you ever thought of considering the foreign companies that are undervalued, or have you for some reason not included that in your universe of companies to consider?
We've
Okay, so first of all, let's summarize what he has been saying for the various points. So essentially what he said is the important thing is to actually hold a company for the long run if you think that is able to outperform the long run by improving the fundamentals, and do not care about the price of the stock. So personally for me, as someone who actually try to invest in high quality companies, this is a point that I resonate deeply with. However, for me personally, when the valuations are extremely high, I do not feel safe to enter. When I like to enter is actually the period of time where you have depressed earnings. So let's move on to my
sorry, we got
second
it.
slide over
Microphone's
here.
open.
So first of all, let's look at the reason why valuation is extremely important. So this over here, everyone knows Microsoft is an amazing company. It's one of the best companies in the S&P 500 that you can buy. And as you can see over here, from the drop in 2000 all the way to actually 2015 to 2016, the company actually remained flat for 15 to 16 years. In fact, from 2001 to 2012, it remained flat, completely flat. So the reason why it was flat is because in 2000s, it was actually trading at a PE of around 70. And what happened was there's what is known as a multiple compression. So a multiple compression is essentially a period of time where the PE actually drops from 70, it could drop to 10. And in this moment, when it drops to 70 to 10, given that the fundamentals remain the same, what you will see is essentially a 90 to 95% drop in the stock price. So what you can see over here is that Microsoft, in the period of time from 1999 all the way to 2012, the company was consistently growing, and it grew at 200% over that time period. And this is absolutely astounding. In a bit more than 10 years, you doubled your free cash flow and you doubled your earnings per share. And the stock price actually still dropped further from the point that you entered. So this over here is a huge caution to investors. Buying high quality companies at high prices may be a mistake. However, if you look at the long run, 20 years, what you will see is that Microsoft absolutely blew everything out of the market. So obviously, whether you are someone that is patient and looking at the time frames, you will arrive at different conclusions. For an investor that look at this time frame in 2013, they would say that Microsoft was an absolutely dog shit investment because of the fact that it didn't go up for 10, 12, even 16 years, depending on where you bought it. So of course, in hindsight, we can say that Microsoft, even if we buy at 2000, it would have still worked well. However, the issue is, imagine if you are a guy who invested at a peak in 2000, and by 2015, would you still have the patience to actually hold on to the company when you finally broke even? Or would you have at that point in time actually sold the company simply to recover the principal that you invested? I think that is more likely that you're actually going to sell the company than actually continue holding it all the way to 2025. So for me personally, in order to manage my emotions, what I want to do, right, is to actually wait for the time where valuations are actually reasonable and fundamentals are actually reasonable as well. And that's when I will enter. What I do not want to see is entering a significant position into a company and seeing it drop 50, 60% simply due to the fact that there was high valuations. So when I'm entering a company that's at low valuation, that is high quality, what I'm essentially doing, right, is actually limiting my downside. Because if it's such a high quality company and it's able to grow its fundamentals at a significant rate, what you will see is that the PE, even though it may not drop much or it may remain flat, what you will see is that the price of the stock actually continues to increase. And an example of that is actually Google. So Google actually started investing it in around 2024, and currently the position is up probably around 15 to 16%. So what you can see during that point in time when I bought Google was that the PE was 22 and currently it is 19. So there is a fall in the PE. However, the stock price actually still gained simply due to the fact that Google's fundamentals are consistently increasing over the period of time. So for me personally, I will only enter into a company under two conditions. The first condition is where the valuation is actually relatively attractive and safe to enter. And the second point is where there's actually a depressed earnings. So let me move on to my next slide to show you why high valuation may make the stock appear to be expensive, but in reality it could be cheap. So first of all, buying at high valuations does not necessarily mean that a stock is overpriced. So what you have to understand, right, is that the intrinsic value of a stock is simply the discounted cash flow of future cash flows that you will get. So first of all, the most important thing, right, is buying companies when the earnings are depressed and not when the PE appears to be cheap. So for example, if you look at Nvidia, like probably a year ago, 2 years ago, what you can see, right, is that it was trading at 200, 300 PE. However, currently, it is trading at 30 PE. So you might be asking, how is this possible? How can it go from 200 PE to 30 PE? And the reason is simply because Nvidia's earnings outgrew the PE valuations that it had. So what you want to do is to invest in companies where the earnings are depressed. So essentially, when the earnings are depressed, what you will see is that the PE appears to be extremely large. And the PE refers to be large because price divided by earnings is PE. If your earnings is depressed, what happens is that your PE appears to be large. So what you want to do is to essentially buy into the down cycles of certain industries. And some industries that you can see now that are in down cycles with poor fundamentals is actually companies in your healthcare insurance sector, as well as a recently posted video on Warrior Met Co. So what you should do is to actually buy in periods where there are depressions in the earnings and wait for the boom in the earnings due to your fundamentals. And this will actually lead to a high percentage of growth in the long run. So lastly, as long as it is a high quality company and it's able to compound its earnings per share and free cash flow at a high rate of return, you will still be able to do well in the long run. So the key word is long run. It is 20, 30 to 40 years. So if you actually are investing in companies such as Nvidia or Palantir right now, what you have to do is to be able to expect that there could be 10, 15 years of no growth at all in the stock price. As long as the business is able to grow at a high rate of return in the long run, what you should do is to essentially keep it in the portfolio. I hope you guys enjoyed this video, and if you guys did, do consider subscribing.